Well, hello, everybody. This is Bob Woosley with FD and FD Fund Administration, and welcome to another episode of Private Equity 360. I'm joined here by Jim Devlin, of Ducker Frontier. And hello, Jim. I'm going to get you to introduce yourself in just a second. But this is one I promised to do a while back. This Jim and his partner Scott and I did a video podcast in June of 2020. When we were talking about the market conditions and what was happening in certain industries. And you're going to hear from what Jim does on market research on M&A transactions for financial buyers and strategics. And I remember saying in the podcast back then that we were going to have a catch up later this fall. Never got around to it. I think the world got a little bit crazy on us, but this is actually the first repeat catch up podcast that I've done since the pandemic started. I'm actually been looking forward to this. So hello, Jim. Glad you're here.
Thank you, Bob. Jim Devlin, Managing Director at Ducker. Actually, it's now Ducker, not Ducker Frontier anymore. We're more of a sister company relationship there, given their global aspects and our focus on the industry. So as Bob had mentioned, our firm does about 50 to 60 transactions a year, wherein we're doing deep dives on competitive landscape, customer voice, market size and forecast, across 5 different industries and really focused on that light manufacturing world and services. And so excited to be here and catch up from our last conversation in June.
Yeah, it's crazy. Who knew what this year was going to look like? But Jim, a little bit more about Ducker Frontier before we keep going. I mean, some financial buyers will commission you to do market studies as part of their diligence when they're going to buy a company or going to sell one. You're supplying that part of it, where a CPA firm like us does the financial due diligence and operational due diligence, our quality of earnings engagement. So can you talk a little bit about your interaction with private equity generally? It's mainly on the buy side, is that correct?
So actually probably a mix of buy and sell. 2020 saw a lot more buy than sell side, but generally we've settled into about 50-50. And so it's become very important on the sell side to have a credible industry report that helps expedite not only the sales process, but also helps bolster where the company's positioned, from different commercial angles. And on the buy side, kind of traditionally, it's a 3 to 4 week, very quick market study. Some of those are in the 1 to 2 week range these days, given competitive pressures on transactions. And so our team's able to execute, given all the corporate work that we do across industries, very quickly. We have 60 years of data internally, as well as a great network and access to decision makers across many different industries.
So financial intermediaries, investment bankers will commission you when they're going out to market a company to do a market study on the sell side.
Correct. Sponsors, on occasion lenders, investment banks will bring us in and introduce us to their clients. In a lot of cases, there is levels of corporate strategic. Now, that's oftentimes when they're investing in adjacencies that they may not have the internal knowledge on, and so we're able to get them up to speed very quickly and help position where a target is and the overall landscape of the industry they're investing in.
So sponsors, private equity firms on their sell side, when they're exiting a company, they'll commission you. Last year, I listened to our podcast and I listened to it and thought about what we said. And one of the things that you and Scott talked about were distressed opportunities. And you're contemplating, I want to put words in your mouth about how there's really going to be an opportunity for opportunistic investors to come in and take advantage of companies that are going to be in distress right now, and ones that might, after the perhaps the PPP loans and other bailouts from government programs, we're going to hit a second wave of distress. Now, the people I talked to said that didn't really materialize this year. What's your read on that? Or last year, I'm sorry, 2020.
So yeah, when we spoke, we were gearing up to do 2-day diligence to be able to support our clients in going after some distressed assets.
Yeah.
I think we were partially right in that the economy continued to I guess sputter along, but at the same time there were assets in certain industries that were distressed. That being said, I don't think anybody saw that the capital markets would continue to hold a lot of these distressed assets afloat.
Yeah.
And I'm not a capital markets guy. Can't explain, where we're at in terms of all-time record highs for the Dow. But that's really what happened. And I think a lot of the groups that were gearing up to go after distressed assets had, kind of pulled back the throttle on that movement.
Yeah.
That being said, these next 6 months are going to be very interesting as we emerge with the vaccination and everything else that we've been inundated with over the last year. Is that a lot of groups that were, private companies, regardless of ownership structure, were only throughout the remainder of 2020, the last 9 months of 2020, a lot of groups, and you can read a lot about this on the lending side, were only paying interest. So they weren't paying principal on their debt, whatever structure that debt is. And
Right.
so I think you're going to see a more, but it's going to be kind of eased into, and it's not going to be a cliff like all of us who lived through 08, or 07 or 01. We would anticipate a cliff. I think there's going to be some easing into some distressed assets and some opportunities as well. But overall, I mean, I'm glad we were wrong. So
Yeah, well, yeah, but this is no judgment about whether it's good or bad that you're right or wrong. I think in general, you guys were pretty on point on the things you were thinking about. And I remember you made a comment about, hey, we're going to redo our forecast pretty frequently, and as situation calls for it, versus a normal recurring times where you updated your Ducker forecast.
Mhm.
The other thing you talked about last June, and by the way, we haven't mentioned, we're recording this in March of 2021, late March. But we were talking about transaction volume and activity, and you had a lot of deals in play coming right at the cusp of when COVID was happening. And you made the comment, it was pencils down. Your pipeline just basically stopped for a while, but you were sensing back then that it was going to start picking up a little bit. Now, we kind of saw the same thing during the summer, was really, really slow, but then start picking up around August or so. Is that,
Mhm.
can you comment a little bit about the velocity and how deals were starting to either stall or get going again? Are you seeing the same thing that we saw?
Absolutely. So it started to ease out of it late summer. Once we got past the elections and there was some certainty around that, the transactions, I would say mid-November through now have increased tenfold in terms of our looks. They've also gotten a lot more competitive, which makes allows groups to bring us in earlier to help with an initial bid, because there may not be a long exclusivity period afterwards. But certainly the deal volume has gone up. There's some certainty in this crazy world of ours. So we've got empirical data on what happened and how they performed if there was another pandemic or something along those lines. And so that's really the attitudes that we're hearing from sponsors and advisors alike.
And Jim, you were actually pretty forward looking when you were talking about the COVID effect on valuations. And I'm hearing that from the investment bankers, like the COVID adjustment. But you were talking about, okay, is this a permanent thing, or what happened? What happens to a business when it comes out of COVID and there's no more COVID in it? What happens to those fundamentals? Can you comment a little bit about what you saw and kind of map it back to your thoughts back then about the COVID effect, both during COVID or coming out of it? Because we're right on the cusp of that right now.
Certainly, we've had a couple different scenarios at play, and so one is we do a lot of work in the aftermarket and things that touch consumers, and so a lot of that held steady. What we anticipated as historic performance in the enthusiast auto aftermarket was correct, but at the same time that there was a boost from stimulus, and we've quantified a lot of those aspects in certain elements of, I'm sitting at home, I want to do a vehicle upgrade, or I want to replace my cabinetry, whatever that might be. There were some elements of the government's payments that did boost those industries. I'd mentioned before we spoke about residential construction.
Yeah.
So residential construction, when I say that means everything from trades and services to supply and distribution. 13 years ago, that was a very hot industry for us, pre-Great Recession. Now, when we've gotten, I believe, half a dozen inquiries in the last 2 months, it's record highs for us in our microcosm of the world.
Yeah.
Because for the last 13 years, everyone has said, if you're going to sell a business, it's got to be 60% commercial construction. Well, commercial construction isn't doing as well as residential.
Yeah.
Now, fundamentals behind that. We talked about last time, there were certain elements of shutdowns that were affecting residential construction that was going to have some pent up demand. Those are things that are permitted already, and we need to move forward. There's certain aspects of governments being shut down, and how do you get that permitting, and how does that move forward? But now when we look at residential construction overall, what we didn't see was the kind of the mass movement from multifamily and from major urban centers to wanting a single family home in the younger demographics, call it the 25 to 35 year old. And so that's really driving what we see as 2-3 years across the board of pent up demand for single family homes. And so we're seeing transactions on the supply side, on the distribution side, on the trade side.
Well, on the demand side, we've seen single family resident funds pop up. I mean, multi-billion-dollar funds and ones that plan to be that big, kind of following Blackstone did the first one, a fund going after single family. And they're basically, the investment thesis is kind of like, multifamily, but, they're buying, big portfolios of single family residence properties, which is, and that's one of the emerging managers, new funds that actually got funded in 2020. Other ones that were in fundraising mode, if you weren't an existing fund, just kind of had a hard time in 2020, just because they're not able to do diligence. But existing managers were able to raise fund 6, fund 7, but single family residents, funds had some success.
Yeah, and I think too, you look at it by different MSAs and in different states, and cost of capital is still relatively cheap to the consumer borrower at this point. Prices are through the roof in Florida right now. Atlanta, the prices are going up where you're at, but at the same time, not at some of the levels that demand might warrant. We look at where we're at in Detroit, everything's remained steady, but the supply is so far down that we're probably 2, 3, 4 years behind what we need to meet population demand.
Are you seeing that is this a COVID effect where people are not so keen on going into their offices? They can work from anywhere. Is it the virtual world that's spurring the hot single family residence market, or what do you attribute it to?
I think a couple of things. One is it's not as desirable to be in a major city in some cases. I think they will come back, but in some cases to walk to the office. That's not something that's required right now, and that's probably not something from major corporations that's going to be required forever. There's going to be elements of it, and it'll be a hybrid approach. I think there's that. I think a lot of folks, when you couldn't fly somewhere, you developed a lot of the outdoor living type desires. People are going camping more. RV sales are up, at least on the trailer side or the tow trailer side.
Right.
So you see a lot of that happening as well as just wanting more space in general. Because
is that COVID, or is that COVID, or is it going to be a thing? I mean,
I think that was accelerated by COVID. We would say is a new normal.
Okay, I want to flip a little bit. I'm going to come back to industries. We talked about that in our last episode, but you did mention the tax law anxiety and we did a podcast back in September before the presidential election. Not you and I, we did it with somebody else, about what would happen if there was complete blue in Congress and the president. And we were looking through the lens of M&A activity. And man, first of all, none of our panelists or guests guessed it would happen, but we speculated if it did happen, that 2021 was going to be a massive M&A year, where motivated sellers were going to come in and go fearful of a tax law change, which we don't think is going to be retroactive in 2021. And we're seeing it. I mean, the volume is like crazy, but valuations seem to be still extremely frothy. Do you guys at Ducker look at supply and demand? I mean, supply of sellers coming into the market and obviously the pent up demand of capital chasing those deals. What's your view on valuation metrics right now?
I guess a couple of different elements. Yes, we discussed it, regardless of what's going on in the world. Sellers tend to look at the election, and December is either very busy or January, depending on whether it goes red or blue. Yeah. It got even further down to folks looking at individual Georgia runoffs and things like that. And
My
so
state, yeah.
those are elements that
Yeah.
especially the individual seller is going to take into account.
Yeah.
I think really what's happening too on valuations is you have data that supports a good investment thesis going forward, regardless of what's going on, and you have a lot of buyers and less sellers from what we've seen.
Okay.
I mean, the banks say that the phones are ringing off the hook, and that's going to catch up. But that sales process to catch up from deciding, okay, things are looking better in November, that's 3-4 months before you take something to market in a smart way.
Yeah.
So I think that's what's happening right now, and I think if the cost of capital increases, then we're going to end up with some more realistic valuations. I don't think they're totally irrational right now, from what I've seen, and this is our small corner of the world, but I think they are aggressive.
Yeah, we've heard some of our private equity sponsor clients have like going, you cannot go, because we have a diligence practice too. And like we just quoted 15 times forward-looking EBITDA and didn't get the deal. It's just like, and the investment bankers that we work with are kind of saying the same thing. Like, man, and yeah, I remember last year in our last episode we talked about speed. About fundless sponsors versus a fund, and being able to react quickly was like really a key thing. I think that's probably only accelerated with this frothy market that we're about.
Yeah,
to
I mean, we've certainly seen folks coming in. There's a limited number of exclusive or potentially exclusive buyers, and somebody comes in and bullies the pot. Only time will tell whether that was a smart or a hair trigger move, but it's happening a lot from what we've seen. I mean, we've had several transactions where we're getting going, and that has occurred.
So let's move over to your read on industries. In the last one, you and Scott really ticked off a ton of industries you thought were going to be still active and interesting, including automobile aftermarket, where you spent a lot of time. But can you give your I don't know if you can recall what you talked about last time, but maybe give an idea of what industries you think, looking in your rearview mirror, did pretty well relative to transactions just in general, and then maybe you could look ahead.
Yeah, sure. As anticipated, there's some pain in commercial real estate, but I think a lot of that's coming back, and folks are finally being able to take a step back and think about what their space and their properties are really going to be in the future, and how that's going to accommodate the workforce. I think we were probably, as we had mentioned before, very close to the majority of what was going to drive the residential markets. Yeah. And I think that was clear. When we start talking about manufacturing and especially here in Detroit, the automotive supply chain, we didn't anticipate some of the chip shortages that are happening. So that's another little divot in the space, driven by the advances in the telecom and tech world because of the requirements for those chips. And so that's something to watch going forward. Aftermarket performance, if you were aware, parts, you did have that March, April, May, but we've seen a lot of adjustments in the space in terms of people are driving more. They're folks that I know that generally wouldn't have been a Sprinter van upgrade buyer or an RV buyer are buying those, and that's not to classify them, but their world of who they can market to is increasing because people just don't want to get on planes still, or with a lot of the contact tracing that's been elevated, they can't, as we had discussed earlier. Yeah. So I think that's kind of our read there. Aftermarket, though, in general, when you talk about performance enthusiast upgrades, that's going to perform well during a downturn, and luckily we saw that. If however, look at this as a downturn. Light manufacturing still rolling along, distribution and services, at their peak. So I think overall, the last 8 months since we spoke, couldn't have asked for better outcomes in a lot of these industries. Yeah. Luckily, we don't cover hospitality and entertainment, and then unfortunately, those venues have had some hard times.
Well, that's really interesting, Jim. I what occurs to me in just talking to mainly the intermediaries, they're seeing like a massive frothy, this is going to be a crazy year, hang on. We're seeing it in our diligence practice that this doubling their staff because being asked to do all these buy side and sell side engagements. I'm just concerned about what happens if, if this thing right size and COVID becomes kind of a memory. We all get vaccinated. Say we're looking ahead in September, and all these things like your example about RVs. Will these people be sorry that they did that, or has this year really changed people's perception about what's important in life and their priorities? What's your feeling at Ducker about that?
No, I think it is. I think across a lot of these industries and products, you like we said, it's a new normal. It's people are adjusted. We're creatures of habit, and this repetition and the last 12 months has been brutal. But I really do think you're not going to see a glut of those vehicles on the markets, depending on, and I think we probably all said this in 9 and 10, depending on the next speed bump. So
and is there going to be a day of reckoning with all this stimulus money and low interest rates? If interest rates pop back up, which a lot of people are talking about later on this year, but we'll see what happens. All right, so let's make your prediction for the next 12 months. What's your crystal ball going to? What should we look for you, Jim, when we catch up with you 8 or 9 months from now?
I think we've settled into some good places across the industries that we covered. I think you're going to see a run on a lot of residential type acquisitions. I think you're also going to see some increases in prices, but maybe offset by some increases in interest rates. Overall, I think this is going to be a fantastic year for M&A. I mean, it's the engine is just, when we talked about starting up in August and then November, and transactions that we were looking at in December even coming back now. And I think you have pent up demand like we show across other industries. And I think it's going to be a very strong year, especially for the groups that are able to make a leap on certain valuations, given some of the dynamics that businesses have gone through over the last few years. I think though across the board there's going to be pent up demand, not just in the transaction world, but also in the companies and the services that those companies provide.
I think that's very insightful and very consistent with what we're hearing.
What do you think, Bob?
Well, I think that just the specter of the tax law change will drive a ton of sellers in there. And I've kind of given up on my thought that valuations become more rational. They are what they are, but there's just so much capital out there. I mean, and we do work with, we're fortunate to have a nice relationship with the Institutional Limited Partners Association, get to kind of understand what pension funds and how they feel about this category. There's no slowing that down. One thing we're keeping an eye on is this proliferation of SPACs, the special purpose, acquisition companies, and what does that really mean? Is that really a thing? Or
I think on that side, I mean, I think overall new asset classes will emerge. SPACs have been good for Wall Street this year. It's essentially everything you read on them. You're pulling forward a company 3 to 5 years, and that's great. I don't think that the story will be written on them for another 3 to 5 years until we get to mature levels. But it's great to see capital coming behind all this new technology, whether it's green or autonomy or however you look at it. So some exciting things coming down the pipe.
There'll be some interesting times, Jim. Thank you. And thanks for coming back. You're the first repeat guest of Private Equity 360. But for all of our viewers, as before and every time, we'll have Jim's contact information so you can reach out. And I definitely encourage you to look to Jim and Ducker, not Ducker Frontier any longer, for some great market research on your diligence, both buy and sell side. So, Jim, thank you so much for coming and visiting with me again. And I really appreciate it. Get your vaccines, and we're looking forward to seeing you in person soon.
Sounds great. Thanks, Bob.
Thanks for listening to one of Frazier and Dieter's branded podcasts. To learn more, connect with us on LinkedIn or visit us at FrazierDieter.com, and be sure to subscribe so you never miss an episode.